While most of the world was celebrating silver's historic breakout earlier this week, something far more disturbing was unfolding quietly behind the scenes. This wasn't normal trading activity. This was damage control. Late at night, away from public attention, top exchange officials and executives from major bullion banks reportedly held emergency discussions. The reason was simple. The silver market was slipping out of their control. Silver had crossed the $75 level, and internal projections were pointing directly toward $100. At that moment, the system faced a brutal choice. Either absorb massive losses and risk collapse, or intervene and change the rules. They chose intervention. In the early hours of the morning, a notice quietly appeared on the exchange website. No press conference, no breaking news alerts, no social media announcement. But the impact was immediate. Margin requirements were sharply increased, at a scale rarely seen before. This wasn't a routine adjustment. It was a strategic move designed to force leveraged traders out of winning positions. When institutions can't win within the rules, they rewrite them. To understand how severe this move was, you need to understand how margin works. When traders buy silver futures, they don't pay the full value up front. They post collateral, often a fraction of the contract's value, to control a much larger amount of silver. This leverage works smoothly until prices rise too fast and the wrong players start losing. The rule change effectively doubled the cash required to hold positions. Traders who were profitable suddenly received margin calls, not because silver fell, but because the requirements changed overnight. Failed to deliver extra cash within hours, and positions would be forcibly liquidated. Imagine buying a home, signing all the paperwork, and then the bank calling you the next day demanding tens of thousands more in cash or threatening foreclosure. That is exactly what happened to thousands of traders. The result was predictable. Forced selling, artificial pressure, a controlled sell-off designed to protect large short positions, particularly those held by systemically important banks. But margin hikes weren't the only tool deployed. Reports began surfacing across multiple brokerage platforms of buying restrictions. Traders attempting to open new long positions encountered error messages. Trading restricted. Liquidation only. You could sell. You couldn't buy. This tactic should sound familiar. It mirrors the same strategy used during previous market disruptions. Remove buying pressure while allowing selling, and prices fall regardless of real demand. This isn't price discovery. It's price engineering. At the same time, unusual activity appeared on order books. Massive sell orders surfaced at key price levels, sometimes representing millions of ounces. These orders spooked traders and triggered algorithmic selling. But moments before execution, the orders vanished. This tactic is known as spoofing. Large orders are placed with no intention of execution, purely to influence market psychology. It creates the illusion of overwhelming supply when, in reality, demand remains strong. The exchange, which is supposed to act as a neutral regulator, has become part of the problem. Its leadership structure is deeply intertwined with the same institutions dominating the futures market. When rule changes favor one side consistently, neutrality disappears. History offers a warning. In 1980, silver prices surged due to concentrated buying. When losses mounted, exchanges restricted buying and allowed only selling. Prices collapsed. Confidence was shattered. But today's situation is fundamentally different. In the past, demand was largely speculative. Today, demand is industrial. Silver is essential for solar panels, electric vehicles, semiconductors, medical equipment, and data centers. You can restrict traders, but you cannot restrict factories. This reality is exposed by the growing gap between paper prices and physical prices. While futures prices fluctuate wildly, physical silver premiums continue to rise. Bars and coins are selling far above spot. In some cases, premiums exceed 40%. That gap tells the real story. The paper price reflects leverage and rules. The physical price reflects scarcity. The market has split into two worlds, one defined by contracts and screens, the other defined by metal and delivery. Buried deep within exchange agreements lies another risk, Force majeure clauses. These provisions allow contracts to be settled in cash if delivery becomes impossible. If shortages worsen, contracts could be voided and settled at manipulated prices. Ownership becomes theoretical. Meanwhile, mainstream financial media remains silent. Margin hikes, delivery risks, and shortages receive little attention. Instead, narratives downplay the situation, framing silver as speculative or dangerous. Advertising relationships speak louder than truth. Why such extreme measures? Because exposure is massive. Large institutions hold enormous short positions. A sustained move higher threatens balance sheets. Losses would ripple across the financial system. This is why regulators tolerate intervention. Stability is prioritized over fairness. Outside this system stands China. Operating through separate exchanges, it continues accumulating physical metal. While Western markets suppress prices, Eastern demand accelerates. Strategic reserves shift quietly. Industrial users are also responding. Manufacturers are reportedly exploring direct supply agreements with miners, bypassing futures markets entirely. If this trend continues, exchanges risk becoming irrelevant. Ironically, these interventions may backfire. Instead of calming markets, they have intensified distrust. Investors are withdrawing capital and converting paper exposure into physical ownership. This isn't just trading anymore, it's a loss of faith. The more aggressively rules are changed, the more obvious the weakness becomes. Strong systems don't need manipulation. Desperate ones do. Despite all interventions, the fundamentals remain unchanged. Mining output struggles to keep pace. Ore grades decline. New discoveries are rare. Demand grows relentlessly. Paper contracts can multiply endlessly. Physical silver cannot. Eventually, industrial demand will overpower paper control. When supply disruptions reach manufacturing lines, price suppression becomes impossible. What we are witnessing is not the end of the silver story. It is escalation. Rule changes signal stress, not strength. The real outcome likely involves a full decoupling between physical and paper markets. Official prices will lag reality until forced to catch up violently. Those holding tangible assets will retain purchasing power. Those relying solely on promises may not. This moment is uncomfortable, volatile, and uncertain. But volatility often appears at turning points. The actions taken now reveal more than words ever could. The system is under strain, and silver sits at the center of it.
Hello my dear friends, welcome back to my another video. So friend, silver is out of control. While most of the world was celebrating silver historic breakout earlier this week. Something far more disturbing was unfolding quality behind the scenes. This was normal trading activity. This was damage control late at night away from public attention. Top exchange officials and executives from major billion banks reportedly hold emergency discussions. The reason was simple: the silver market was slipping out of their control. Okay, silver had crossed this 75 level and international projects were pointing directly toward 108 date 1008. The movement the system faced a brutal choice: either absorb massive loss and risk collapse. Very, very silver is out of control. This is the real reason. Or enter and change your rules. So friends, this is received my video. So please like my video and share this video and subscribe my channel. Thank you so much.